Investing is the process of using money to purchase an asset with the goal of generating a return on that investment. When done correctly, investing can help individuals grow their wealth and achieve their long-term financial goals. One of the most powerful concepts in investing is compounding, which is the ability of an investment to generate earnings that are reinvested to generate even more earnings over time. Compounding is often referred to as the eighth wonder of the world, a phrase attributed to the famous physicist and mathematician Albert Einstein. Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." This statement encapsulates the power of compounding, which can work for or against an individual depending on whether they understand and utilize it correctly. $1,000 in a stock that generates a 10% annual return. In the first year, the investment would grow to $1,100. In the second year, the return would be applied not just to the original $1,000 investment but also to the $100 in earnings generated in the first year, resulting in a total investment value of $1,210. Over time, the compounding effect becomes more significant, resulting in exponential growth of the investment. The power of compounding is particularly evident over long periods of time. For example, if an individual invests $10,000 in a stock that generates a 10% annual return and leaves it untouched for 30 years, the investment would grow to over $174,000. This represents a 17-fold increase in value, with over 90% of the total growth coming from compounding. In addition to investing in stocks, there are many other ways to utilize the power of compounding. For example, individuals can invest in bonds, mutual funds, or exchange-traded funds, ETFs. They can also use the power of compounding to pay off debt, such as credit card balances or student loans, by making regular payments that reduce the balance over time. One important factor to consider when investing for the long term is the impact of fees and expenses on investment returns. Even small fees can have a significant impact on long-term investment returns when compounded over time. For example, an investor who pays a 1% annual fee on a $100,000 investment would pay $1,000 in fees in the first year. Over 30 years, assuming a 7% annual return, the impact of these fees would reduce the total investment value by over $50,000. Another important consideration when investing for the long term is the impact of inflation. Inflation is the rate at which the general level of prices for goods and services is rising, resulting in a decrease in the purchasing power of money over time. To ensure that investments keep pace with inflation, it is important to invest in assets that generate a return that exceeds the rate of inflation. One strategy for mitigating the impact of fees and inflation on long-term investment returns is to invest in low-cost index funds, which offer exposure to a broad range of stocks or bonds at a low cost. By investing in a diversified portfolio of low-cost index funds, individuals can capture the long-term growth potential of the stock market while minimizing fees and expenses. Another way to maximize the power of compounding is to start investing early and consistently. The earlier an individual starts investing, the more time they have to take advantage of the compounding effect. Consistent contributions to an investment account can also help to maximize the power of compounding over time. For example, imagine an individual invests $1,000 per year in a stock that generates a 10% annual return. After 30 years, the investment would be worth over $114,000, with nearly 70% of the total growth coming from compounding. This example illustrates the importance of consistent contributions and the power of compounding over time. It is also important to diversify investments to reduce risk and minimize the impact of market fluctuations on investment returns. Diversification involves investing in a range of assets, such as stocks, bonds, and real estate, to spread risk across different types of investments. This can help to minimize the impact of any single investment on the overall portfolio and reduce the potential for significant losses. In addition to diversification, it is important to develop a long-term investment strategy that aligns with personal financial goals and risk tolerance. This may involve setting clear investment objectives, such as saving for retirement or a child's college education, and developing a plan to achieve those goals over time. It is also important to periodically review and adjust investment strategies to ensure that they continue to align with changing financial circumstances and market conditions. Overall, investing and compounding are powerful tools for achieving long-term financial goals. By investing early, consistently, and in a diversified range of assets, individuals can take advantage of the power of compounding to grow their wealth over time. It is important to develop a clear investment strategy and to periodically review and adjust that strategy to ensure that it continues to align with personal financial goals and market conditions. By doing so, individuals can maximize the potential for long-term investment success and achieve financial security over time. Overall, investing and compounding are powerful tools for achieving long-term financial goals. By investing early, consistently, and in a diversified range of assets, individuals can take advantage of the power of compounding to grow their wealth over time. It is important to develop a clear investment strategy and to periodically review and adjust that strategy to ensure that it continues to align with personal financial goals and market conditions. By doing so, individuals can maximize the potential for long-term investment success and achieve financial security over time. Another way to stay focused on long-term investment goals is to seek the advice of a financial advisor. A professional advisor can provide guidance on developing a long-term investment strategy, managing risk, and navigating complex financial markets. They can also provide valuable perspective and help investors maintain a disciplined approach to investing over time. In conclusion, investing and compounding are powerful tools for achieving long-term financial goals. By investing early, consistently, and in a diversified range of assets, individuals can take advantage of the power of compounding to grow their wealth over time. It is important to develop a clear investment strategy, maintain a long-term perspective, and seek the advice of a professional advisor to maximize the potential for long-term investment success. With careful planning and disciplined execution, individuals can achieve financial security and independence over time.